Our next guest says that wouldn't even necessarily be bearish for stocks. Let's bring in Mike Wilson, the CIO and Chief U.S. Equity Strategist at Morgan Stanley. Mike, market's selling off a little bit today, but to your point, this is nothing like what we might have seen if there were much bigger concern about massively spiking oil prices and instability across the region.
I think that's right, Kelly. I mean, the president is obviously acting very tough and supportive of Israel, which I think is the right stance. But at the same time, he's leaving the door open for negotiations. And as you rightly point out, I mean, oil, is behaving quite well. I mean, I think if oil were to spike to $90 or something north of $90, we'd have a real problem. But that's not the case at the moment. That could change. I mean, we don't know how these conflicts are going to escalate. But right now, the markets seem to be very comfortable with that. But that's not the reason we're bullish. We're not bullish because we're hoping for some conflict here. We're bullish because earnings revisions have turned up, and they've turned up meaningfully since the middle of April. And I think that's the real story here for stocks. It's not about all of these distractions. It's about that, we made a significant trough in April, but from a market standpoint and from a rate of change standpoint on earnings. And it's that simple.
Right. So that's telling us that there's some, economic momentum here that could keep going. Does it matter, right? Do we have to just kind of resolve it, get through a few of these issues first? There's a tariff deadline coming up in a couple more weeks.
Yeah, that's right. I mean, we have a lot of things to get through. We have a tax bill still to, vote on. We have a debt ceiling and a reconciliation process. We have obviously tariffs. We have this conflict in the Middle East. I mean, but there's always things to worry about. And that's why our process is very focused on what we can actually analyze. And what we can analyze is that, once again, the rate of change on earnings revisions, on fiscal policy, on even tariff policy and immigration, and all these things that were kind of dragging on growth earlier in the year. And I won't leave out AI, but AI CapEx is kind of bottom now, too. Those are the more important issues, and it's creating opportunity to do things both long and short, quite frankly, within the equity market.
I was going to say, it's a hard story to tell, isn't it, Mike? Because from your side and from our side of the camera, and I don't think a lot of people fully maybe understand this, it's hard to say, don't worry about what's happening in Iran or Israel because NVIDIA earnings is going to be fine, right? You agree that that's a hard thing to say, but maybe that is the reality. Maybe the earnings growth for NVIDIA and AI and Google and whatever it is, that is not connected to, I don't think, all the stuff that's getting the headlines right now, is it? But that's hard to say.
Well, I mean, it's a hard job, right? It's a hard job to be an investor. It's a hard job to be a strategist. And but that's what we get paid to do. And we have to focus on what we know. So just like it was hard earlier in the year in January, we were saying negative things, which was challenging because everybody was bullish and the markets are going straight up. But we felt like the rate of change was now turning down. So when things corrected significantly, that created an opportunity. So we're not here as Pollyannas to say, oh my goodness, this conflict doesn't matter. Of course it matters, and the human life risk there is terrible. So we don't want to diminish that risk. Okay, what we're saying though right now is it appears that the markets that are going to be most affected that would hurt equities, for example, oil prices, they're not really reacting the way that would be a problem. That's not the only thing we're watching. We're watching a lot of different things as well. But right now, it feels like this is maybe a 5 to 7% correction type of an event for now. But we got to stay vigilant. We're not sitting here ignoring that. But I'm trying to tell you is I think what most listeners don't appreciate is that we had a very bad setup at the beginning of the year. We corrected for that. And now, actually, the fundamental drivers have turned. And that's what people need to focus on, both at the stock level and at the index level.
Understood. And quickly, Mike, you mentioned there's both long and short ideas that you see out there. Can you just get any more specific on both sides of that?
Absolutely. And that's also predicated on kind of where we see the best revision factor. So on the positive side, first, I would say it's capital goods companies, financials, as well as software. On the more negative side, it would be consumer goods, consumer discretionary, some of these areas that are affected by tariffs the most, and high interest rates. So small caps as well, we think probably continue to underperform because of the rate structure that we're seeing right now. But even there, I think there's some sight of line on a Fed that's probably going to get more dovish in the second half of the year. So, we got to stay, alert. We can't just sit on these positions. But right now, what I just told you, that's how we're set up.